First of all, I like to have pride in what I do. Is I'm thinking about that Sinai Desert example. And I think one of the things that give Jim and me and the whole team here at Paladin a lot of pride is the fact that we have developed 40,000 affordable, badly needed affordable housing units down in Latin America. And the last dozen projects that we've done are zero carbon footprint. And so, there's a lot of feel good about what we do. And when I look around at some of the projects that we've renovated here in Los Angeles, when we had 2/3 of one building, existing tenants voluntarily move into an upgraded unit and pay. We gave them incentives to do it, but we don't really want to evict people. What we want to do is provide a nicer yet still affordable place for them to live. And one of the fallacies of folks who often look at workforce housing, particularly if it's an immigrant tenant base, is that the fallacy is the thinking, oh, they want to live in the cheapest place possible. No, they want to live in the best place and the safest place because they have families too. So there's a lot of pride, frankly, in what we're doing here. And we always underwrite to make sure that our pro forma rents are within reach of the median household income of that community. We don't want to be out of reach of that. I think that there's a way to accommodate both in a manner that doesn't create a conflict. That's super important to us. We do not like and believe in conflicts of interest. So we don't want one Paladin fund to buy from another. It's one of the reasons it was very easy for us to become an RIA, because I think those things are no-nos for registered investment advisors. Although there are some options, and we always try to deliver what our investors are looking for first and foremost. And historically, we've done 800 million of value-added apartments over the last 30 years, 90 investments, over 15,000 units. The vast majority of our investors want us to harvest once value has been created. So we typically take 2 to 3 years to upgrade a property. And there's a typical kind of process that we go through to improve the operations and correct the physical deficiencies and really optimize the operating performance and the market potential of a property. And after I think on average, we've held for somewhere in the 3 to 4 year range, even though we might underwrite to 5 years. Some of our investors are increasingly asking us don't want us to return the capital and would rather have us refinance and then clip coupons, because they recognize, because many of them are cash flow oriented, but they recognize the inflation hedge protection that real estate in general, but in particular this little sector of real estate provides. So we may end up having different buckets of capital with different objectives, more of a value add, IRR driven, total return driven, 3 to 5 year hold bucket of capital, and then a longer term hold, not indefinitely, but maybe a 7 to 10 year hold where there might be a value pop, but once, rather than sell, we refinance a property and turn it into an attractive annuity until we ultimately sell it. I think we'll end up actually with both types of investors, because we've been having ongoing conversations and our investor base is kind of bifurcating into those two interests. And there's opportunity for both. And, we'd like to accommodate both if we can.